Welcome to Joe's Happy Hour, a show about markets and life hosted by Joe Fahmy. This podcast is for informational and entertainment purposes only and should not be regarded as personalized investment advice or relied upon for any investment decisions. Joe Fahmy is an employee of Zor Capital, and he and his clients may maintain positions in the securities discussed in this podcast. All opinions expressed by Joe are solely his own and do not reflect the opinions of Zor Capital. The views expressed by guests are their own, and their appearance on this program does not imply an endorsement of them or any entity they represent. Thank you and enjoy the show.
Josh Brown.
Joe Fahmy.
Welcome.
I can't believe I'm here. This is epic, dude.
I'm usually doing your podcast.
I know.
So
this is amazing.
Thanks for being a guest.
It's amazing.
Joe's Happy Hour. We got an hour. We got to be happy. Let's make it happen.
I'm already happy. I don't know if you could tell.
You just wrote a new book.
I did.
You've written 4 books. I don't think I've read 4 books in the time you've written 4. My first question I got asked, how do you organize your time? The first thing I said to myself when you told me a new book was coming out, in my head, I'm like, when does he have the time? Because you got TV that you're doing, sometimes remotely, but if you have to go in studio, we know traffic to wherever in New York is brutal. That's time consuming.
Never easy.
You're running 3 or 4 podcasts yourself.
Yeah.
Oh yeah, and I forgot you're running a multi-billion RIA. You have a family and
trying
kids.
to stay married.
Trying to stay married with family and kids, and you're also trying to be social. Like me, we go to concerts and sporting events and dinners and so forth. So my first question is, how do you manage the time? How do you do it?
So I write very stream of consciousness. I will sit down and I will bang out like 2,000 words. And I won't get up until I finish it. And I put my phone on airplane mode and I just go. And then I won't obviously press publish because it's a book, thank God. So I will go back and probably take out. I'll probably do more elimination after the fact. I think the number one thing is get the writing done. And then secondary to that is don't edit it just after you've written it because you're still going to be in love with it. Go back the next day, the next week, go into it and then just say like, all right, this is too much, or I went in a weird direction here, and like accept the fact that a first draft is a first draft. So the way I got the book done was the summer of 23. I just basically said, all right, I have 22 chapters. I'm going to rip through these this summer. And then I took my time. I went back. I finished them. One of the crucial things I learned from Stephen Pressfield is don't try to do research while you're writing. Get the writing done. Yeah. Research will only slow you down or put you in doubt of what you're actually trying to say. Say the thing, and then go back and fill it in with all the research.
So when you're thinking of a thought and you said, oh, wait a minute, I got to look this up, don't do the research. Continue with your thoughts.
I won't do that. So it starts with research. So I don't want people to think it's like, hey, I'm ranting. So if I have a chart I want to write about because I think it tells a bigger story, I start with that chart. So I have some research. But then I might want to go in a direction that I don't have all the data in front of me. I don't let that stop me. I'll write what I think. I'll go back. If the data says that I'm right, that'll be included. If the data says I'm wrong, then that's what the chapter becomes about. Wow. It's like, this was what I thought, but actually here's the truth. So the research is later in the writing process. For me, the writing process is I have a really either strong opinion or a very different take than anyone else, or it's a somewhat common opinion, but here's why it's true. And I'll write it. And then in the editing process, if it turns out that there are nuances to it that I left out because I've done the research, that makes it an even better piece of writing. So I want to end with something that's real and true and hits you in the gut and is emotional, and that's why I have to do it that way. If I work the other way, where I write a sentence and then I go look up to confirm everything that I think, first of all, it'll take forever.
Yeah.
Second of all, it'll take all of the spirit out of the thing. It'll take all the gusto out. So this is a blogging process, basically, but without hitting publish. Yeah. Because you have time. So that's the way I did it, and I don't recommend that to everyone, but it is a method. It's a format.
I mean, it's just a longer form of, we got to know each other and we original bloggers and so forth and financial, but you were always stuck out from everybody else. Like I would occasionally blog, other friends would, but you didn't just consistently do it. It was, and I mean this sincerely, like they're masterpieces on blogs. And you'd sometimes just going home on the Long Island Railroad be writing things, which I'm like, even just for blog posts, they're amazing. You know?
Yeah. So one of the things with the book that I said was the best books that I've ever read. I think you can tell that the author has this thing and they're bursting. They have to get it out. And I think that when you're reading a book like that, you know it. So I didn't want to do something where it was like, oh, I have to write the book now. I wanted to do something where it's like, I have to say this.
Okay.
And there's a momentum to that. So we chose 20 some odd topics in the book, and they all tie together. But the idea was these are the things that I'm most excited to write about, or I feel like I'm compelled. I have to get this out. If you're writing something on an assignment, like a reporter or somebody says, here, give me 500 words on this topic,
Yeah.
It's really hard to do something great.
Especially if you're not passionate about it.
If you're not passionate about
Right.
it. But for me, this is like the story of the markets and my life and how the two things are intertwined. So it came really naturally, and I somehow I knocked it out. It helped. It helped that my kid was in sleepaway camp. I'll tell you that.
Were there parts that you wanted to keep in that the editors wanted to take out, or vice versa, parts that the editors like said,
Yes.
hey, you should put this in or something like that?
There was
I'm
only
curious how much influence they have.
There was only one. I went after somebody personally,
Yeah.
and the editor. This is somebody that used to appear a lot on CNBC, and I think he's one of the worst people. Just his motivation for what he's saying to the public is pure evil, and I know it. And I did this. I probably did like 700 words on don't listen to this guy. And then the editor, they were English, and he's just like, you know what, dude? I could tell how badly you want to say this because you think you're going to save people or whatever.
Yeah.
All you're going to do is turn the book into this thing about that guy. And it shouldn't be about that guy. It should be about you.
People will take that one section
And people, that will be the thing that everyone thinks the book is about. And the book's very positive. It's not, the book is not about like settling scores or, you know me.
Yeah.
I'm happy. I don't have any enemies that I know of. But I was using this as an example, and maybe in the writing it crossed over. It got too personal, and that's why you work with an editor.
Yeah.
And you don't
To
self-publish.
check you a little bit.
Well, the editor's like, dude, you don't want to do this.
Well, if I was good, I'd ask you who it is and get it out of you. But I don't know if I can or not.
You can, but you can't right now.
Okay.
All right.
That's fine. Because obviously people are going to be like, who is it? Who is it? I'm like, I respect.
I mean, this
respect.
guy is just ass cancer. Like, he is somebody that wakes up in the morning and says, how can I trick people into buying whatever? And
Is this person still on, or they got rid of him?
No, gone.
Okay.
Gone.
All
It doesn't matter. You know, look,
Yeah.
in the end, I didn't want the book. The judgment of Harriman House, my editor, was correct. I didn't want this to be a book about, you know, here are all these people that I want to settle scores against. I wanted the book to be about, like, how do you take the stuff that I'm sharing with you and utilize it to become a better investor? So what I ended up doing was I characterized the things that I think are wrong in the financial media and the type of people that I think you want to stay away from without making it personal.
Yeah.
And I think it's a stronger book because of that.
No, I agree because there's so much great stuff in here, and if you don't want people to take 2-3 pages out and basically characterize the whole book based on
100%. So I think the judgment of the editor was the right judgment.
Yeah. There's a theme in the book about just how everyone's human, pretty much. There's a lot of I think too many people put, not just people on Wall Street, but musicians and athletes and business people, like, on too much of pedestals when they don't realize, like, we're all fighting the same fight.
Yeah.
We're all human. I always say the 3 biggest areas that people stress about are their relationships, whether it's with your significant other, with your kids, your finances, whether your business paying your bills, and your health. Those are the 3 biggest, even if it's not yours, a family
I think
member.
there's a 4th one, and it's some people would include this with finance.
Yeah.
But I think it's its own thing. I think there are people who are bitter with the way their careers have gone. And I think that there's a big element of that in the book too.
Yeah.
Because I've come across a lot of people who are really smart. If you get a job at a big Wall Street firm, you're obviously smart. Like you went to a good school. There's no other way to do it.
Right.
I think that there are people who are biased in the way that they talk about investing or the markets or the economy by regret. And they may not even be aware of it themselves, but I see it and I know it.
So they either have a chip on their shoulder or regret, and it carries into their communication, their views on the markets, whatever their...
It's the negativity. It's like seeing everyone else make money in the markets because the markets rallied, or seeing the economy not fall apart. And there's a part of them that kind of was rooting for other people to be brought down a peg. And I see it. I know it. I'm aware of it. And I also understand the tendency, because I know what it's like to feel like you missed out on something.
Oh, absolutely.
So I own a bunch of crypto. I don't own enough that it would change my life. I could have. I was buying it at 3,000.
Yeah.
Was I excited when it went to 30,000? No. So I understand that tendency to watch other people succeed and say, that could have been me, that should have been me. And I understand how that mentality can then color the market commentary of those people. So I try to incorporate some of that stuff into the book as a way of saying, like, everyone's human. Everyone has these regrets, or everyone has this bitterness about things that went well for others and not them. And understand that when you're listening to someone talk, understand that that's a part of their personality. That's a part of their character. And it definitely is going to bias what they're saying or how they're feeling.
But that takes a little bit of like insight, self-awareness to recognize that. Because what I was saying is that, okay, so we're all human. We all stress about a lot of different things. And, you're basically saying like, we're all human. And, there's a part in the book where you really recognize like, hey, this goes out to the people who've been through a lot, but still fought through it and so forth. But, to recognize that when you see someone writing a blog or someone on financial television, to recognize that their bias is affected by something personally, that's tough to acknowledge that.
Well, what I wanted to do was not villainize somebody for being wrong, but to just point out, here are some of the reasons why this person is like a shopping cart with one broken wheel, and no matter how hard you push that thing, it's going to veer into recession, like commentary. Like, those people are out there, and I've met them, I know them, and I feel for them on a human level. It's like, of course this guy's miserable. Look what he just spent the last 15 years saying.
But you have to be able to separate that.
Well, what you should come away from the book with is everyone in this business, everyone commenting on the markets, the economy, it's a person. And what else is a person if not just this agglomeration of all of their experiences and regrets and wishes and hopes and personal experiences? And when you understand how human everyone really is, I think you're on an elevated plane listening to the discourse, and you can like kind of say, all right, I get what this person's incentive is for saying this. I understand that person's motivation. All right, I know where that guy's coming from. I know where she is taking this conversation and why. And I'm no different. So I have my own personal biases and beliefs and experiences and wishes and hopes. And that's really what I wanted people to take away from, reading the chapters about all these events in recent market history and how it affected people.
Yeah, and I think one of the lines was, no matter how successful people are, there's always a backstory. There's always like something that they had to fight through. And I think a lot of people, they say, well, I'm fighting through this stuff in my life. Well, yeah, so is everyone else. That's the thing. One of the things I think that you stress.
The phrase is be kind because everyone's fighting a difficult battle.
Yeah.
No matter, you might look at someone else's struggle and say, big deal. You know what? There's this weird thing in life where if you're in a group of people and everyone throws their own problems into the pile, and then you say, okay, pull out any problems you want.
Yeah.
Everyone's going to pull out their own, right? It's a weird thing, but if you really think about it, like
It's an interesting.
you're not going to take someone else's problems. You're probably going to take your own back because the devil you know. And so I try to humanize the stories of the markets that we've all just lived through and kind of really give people a sense of everyone that you're reading about, hearing about, they're all going through their own shit.
Yeah, you mentioned something that just came to mind about people being wrong. It's kind of a thing where if someone writes a blog post or is on Twitter Spaces or on financial television and makes a call on the market or a stock and they're wrong, the amount of insecurity and defensiveness people get is ridiculous because I don't look at someone who says to buy this stock and they're wrong and I want to attack them and say, oh, you suck. Like, we're all wrong. We're all wrong. And you are on regularly where you have to make calls. But my point is, I almost feel like people should accept and be a little bit more tolerant rather than saying, pointing fingers, like just because someone's on TV, they have to be an expert and be right on everything. But I'm just like, I'm wrong all the time. I just don't.
Yeah, but it's projection. It's people are lashing out at other people who are wrong because they look like the weak animal. And it's like, I can get this guy now. So there's a lot of that, but then there's like this projection where it's like you criticize someone else for being wrong as a way to show other people that you're not wrong.
Yeah.
And nobody wants to be wrong
it's
ever.
Hypocritical. But I mean, I don't like. There's a thing with the markets. Like you just cannot. You have to separate your ego from the markets. So
easier said than done.
Right, but I'm wrong all the time. I'm not saying. I mean, I just try to minimize my losses and don't stay wrong. But I've also made some great calls too. But I don't let sit there and scream from the rooftops. It's just
Joe, think about it this way. You watching the World Series at all?
Yeah.
Okay. So Aaron Judge
sucks now. He's the worst player in baseball because of 3 games.
Okay, but every at bat, what do I don't know, I think 8 million people are watching the World Series.
Yeah.
What do 8 million people say every time he's at bat and he pops up or he strikes out? So this guy sucks.
Yeah. I was being sarcastic, by the way. I love Aaron Judge.
Well, because everyone knows he doesn't suck. Like, everyone understands this is one of the greatest living athletes.
Right.
I agree. This is maybe a Hall of Famer. This is like a guy that will probably hold some records.
And he has an incredible demeanor. Love his personality.
But it doesn't matter. When he strikes out, and you just saw him do that twice in the same game, it's almost a reflex. If you're watching, you're like, this guy sucks. So nobody wants to be the this guy sucks guy.
Yeah.
Nobody wants to be Aaron Judge in that moment. So when you see somebody like Paul Tudor Jones, or you see Stanley Druckenmiller or Steve Cohen or any of the billionaires that once or twice a year pop up on CNBC, you see these guys, they get something wrong. That idiot, I'm smarter than him. You know you're not. Like, everyone knows that they're not smarter than Stanley Druckenmiller. But I was there in 2010. He was at the Iris Own conference. He was pitching fire and brimstone, and it was actually a major market bottom.
Yeah.
But I was there. I mean, basically, it was a train wreck, and there was no way to avoid it. I saw Howard Marks do this in the mid 2010s. I saw a lot of people do this at the end of 2022. Guaranteed recession in 2023. People get things wrong. Right. Very smart, talented professional people. There's a tendency when you see someone powerful brought down over one call for like 5 seconds, you want to pile on. It makes you feel better about yourself.
It's kind of pathetic, if you ask me.
I know, but we're animals. We have instincts.
People are humans. I get it. But what I love about Druckenmiller is I've seen a lot of his interviews lately because he didn't do much when he was managing money. He did one afternoon one time.
That's the other thing people say. Washed up hedge fund manager.
No,
there's a reason he's a family office.
Yeah, he just said I would never have done this when I was managing money. He even said I must be washed up because I would never do an interview during market hours. And he did one, and I haven't listened to all of them, but he talked about, he's if you add up all of his shorts, he's down money. And there's a guy who made $1 billion in a day shorting. But he admits that. He's like, I sold Nvidia too early. I made a mistake. And I'm like, I love that humility about him.
I think that's one of the reasons why he's among the greats. Is not just his track record, which speaks for itself. He's one of the guys that comes on and says, I was saying this 6 months ago, didn't work out that way.
Yeah.
How you can count on like one hand.
Arguably one of the best, has no problem being being humble and saying he's wrong, but douchebag trader on Twitter is like, I'm never wrong, I'm 100%. It's unbelievable how you can learn from the best.
Stock Genius 6969420 has never ever been wrong about anything.
Right.
All right. So you would think that people would see that and be like, "Wow, that's one of the greatest traders who ever lived," coming on and saying he sold Nvidia early, and then they would like internalize that, and it would manifest itself in the way that they carry themselves on social media, but that's not actually how it works.
No. I know. It's all rhetorical. We know people are lunatics. Speaking of one of the best, you tell a story in here on Tepper at the...
Yeah, you were there.
I was sitting next to you.
That's right.
And I remember it was, right here. I made a note on this. It was about the SALT conference when Tepper gave his opinion on the market, and we were sitting next to each other, and you like instantly put out whether it was tweet or blog post, and it like literally moved the markets. If you want to tell that story, I love that story.
Well, so it's one of these moments in time where you and I and JC, we watched in real time somebody become a market god.
Yeah.
So he had put up insane numbers as a hedge fund manager, not as a commentator. It's like as a guy really managing money.
Well, a lot of money, yeah.
A lot of money. He put up insane numbers. He was right on the precipice of people in the hedge fund world know him, but people in the media, kind of they heard his name, they don't know why. And people in mainstream America have no idea who he is. And it was right at that tipping point at the SALT conference. That was at 15, 14?
Yeah, right around there, yeah.
Okay. So it's right at this moment where his fame is about to cross over and he's about to become like one of those guys, one of those names. And those names are like Cohen, Soros, there's not a lot of them.
There's a handful,
but that's
like
the
you said.
moment where he became one of those names and we were there. And just the way he sat down on stage, there were these like 80-foot screens behind him and the mooch, and the whole audience is his peers. They're all hedge fund managers.
Yeah.
They all go to sleep at night dreaming like someday I want to be David Tepper. And Anthony read out his track record, which the room was like, because I think people knew that he had made money, but people didn't understand like how good he was. And he owned the place for that moment in time.
Yeah.
And I remember seeing him out by the pool, and people like, I guess this is maybe before selfies. People are doing selfies, but so they kind of weren't taking pictures with him, but they were like crowding around the pool to watch him bathe. It was very odd. And then I remember how guarded over the course of those 3 days he started to become. It's like the first night there, he's like, "Everyone back to my suite. Let's do drinks." And like we were up in his hotel suite, like doing shit. He was behind the bar. Like by night 2, I tried to introduce someone to him, somebody that worked at maybe Wall Street Journal. And he's like, like you could see it becoming like overwhelming, the amount of attention that he was getting.
Yeah.
And, now, of course, he's family office, owns the football team. He's away from Wall Street. He's probably happy. But, like, we capture that moment. And I called the chapter the apotheosis of David Tepper, which is Greek for when a human becomes a god. And he really, like, in that moment, that was it. That was his moment.
Yeah. No, it's a great chapter in the book. You also talk about the pandemic.
Yeah.
And its effect. There was a line, the American dream doesn't work unless there are people who have to do something that they don't want to do because they're in pursuit of their dreams.
Yeah.
That's that's very profound, I think.
So we actually titled the book after that chapter, and it's just one of these revelations that I wanted to write about where we ran this unwittingly. We ran this social experiment. The question was, can we keep the economy running if nobody except for essential workers have to go to work? Like, what happens if you make it so nobody misses a bill, nobody gets fired, everyone has money in their bank account, and, like, everyone's just good all at the same time?
Yeah.
We've never done this before. So we sent out 3 tranches of payments directly to people's bank accounts. We gave every employer in the country the opportunity to not fire people and be paid for not firing them. We saved the restaurant industry. We saved Broadway. We saved the airlines. We saved the cruise ships. We saved schools. We outfitted everyone with the equipment they need to keep working. The country, we did all of this like in the span of 3 months.
Oh, yeah, on steroids in a very short period of time.
And here's the result of the experiment. It broke the economy in half. And the reason why is because if everyone has unlimited freedom, they could work from home, they could not work. There were people with 2 full-time jobs at the same time. That was a phenomenon, pretending, right? Full-time employees, but for 2 companies. We had people leave an industry they hated and go into a new one. We had people start their own businesses in the millions. We had people just decide they were going to take 6 months off and do nothing. We had people go from, I used to drive a truck, now I bake sourdough bread. We had every version of people having the complete financial freedom and spatial freedom. Nobody needs to know where I am right now. And freedom of how much time they could spend doing what they wanted. And they all paid their bills and they were all able to live. And it sounds like a utopia until you get to 9% inflation. And you don't have people working at the ports. And you don't have enough people willing to drive trucks. And McDonald's is begging people. They have to double their hourly wage just to get somebody in the store. It literally broke the economy. And so the lesson from that is the American dream is still alive, but we can't all have it at the same time. We need people who have gotten there already, who are spending money, and then we need people who are still striving to get there. And those people will do the jobs that the people who have already made it used to do. Like, there's a progression to the American dream, and it can't be shared universally all at once, and it can't be underwritten by the Treasury and the Federal Reserve. It has to be something that people achieve in stages. And that was kind of the thing that nobody wanted to say out loud, but that's the truth. Sometime circa late 2020, early 2021, we gave everybody everything they ever wanted all at once, and it destroyed us. Like, we did not have a functioning economy. We had SUVs being delivered without microchips in them. Like, it's just, it doesn't work. And so that's what I tried to do in the chapter is I compiled all of the stats, all of the money that was given out. 11 million companies were given PPP loans. 10 million didn't pay it back. The amount of municipalities, states, cities, school districts, counties that were all just being handed federal money. It was just this incredible experiment, and it failed. And I don't think we're going to run it back ever again.
So when this has been my theory with the Fed and the Treasury and so forth. When they are concerned about a potential problem, they do everything they can to pump liquidity into the system to keep the markets from falling apart. And I think as far as when I started my career, mid-90s, Y2K was a big fear at the time. Yeah. They were worried at the stroke of midnight in 2000, every computer is going to blow up and be erased. So we just didn't have bloggers, financial television, and social media sites to really promote all this. But they doubled the money supply. They did everything they could to pump the system with money to keep what they thought would be a disaster from the markets falling apart. And I think the same thing it's happened periodically throughout history, but a once in a century pandemic, the Fed did everything, and the Treasury, everything they could to say, okay, we know the virus is going to get worse, people are going to die, but we don't want the economy to fall apart.
Well, one of the critiques that my partner Barry had about the response to the great financial crisis after 2008 was that there was no real fiscal response. It was all Fed, and it didn't work. So the Fed took rates. The Fed took rates to zero. You would have thought that would have produced a roaring recovery. We had one of the slowest economic recoveries on record. The housing market was still in a state of disarray. 10 years later,
a U bottom where it just took forever to
took forever. And we never really got the pace of hiring back that we had been accustomed to in the pre-GFC period. And there was a lost generation. I think to this day, we had millennials living at home with their parents. We just never really got back to what we should have gotten back to. And the main reason is that the Fed did all the work, and our fiscal situation was so politically divided that they just, keep in mind, it's Obama. It's the first African-American president. Yeah. Half the country lost their minds. They turned to right-wing talk radio, and anything he did was going to be, this is evil. And as a result, you basically had Congress set itself up in opposition to Obama. It didn't matter what he proposed. And he didn't have any great answers either. So that's how you end up in 2011 with the debt ceiling debate for the first time, where Standard & Poor's has to downgrade the U.S. Treasury as a bond issuer from AAA. This is all unprecedented. And that's a result of, I think, a lack of fiscal coordination. So they put the whole thing on the Fed, and it took forever. What's different about the response to the pandemic is the Fed and the Treasury and the Congress all worked hand in glove.
It was all coordinated.
It was very coordinated, and it was way overboard. It was almost like a contest. Oh, yeah? Treasury's doing that? Wait till you see what Congress is about to enact.
Yeah.
And then the Fed said, oh, yeah? Hold my beer. Wait till you fucking see this shit.
I remember Steve Leisman.
It was $21 trillion was the end result.
Was announcing what the Fed was doing, and he took his glasses off to the tip of his nose, like
That's
saying,
right.
They didn't just throw a bazooka. They didn't just throw the army. I mean, even him, who I respect his opinion, he was in shock because we talked about this, I think, on your podcast. The Fed bought more treasuries in the 3 months after the pandemic than they did in 9 years from 2009 to 18. They bought more treasuries in 3 months.
Yeah.
So it's not just the money they flooded in, plus the fiscal stimulus, plus Congress, plus interest rates at zero, expanding the balance sheet. It was literally forget opening the spigots. It was a Niagara Falls of liquidity. But the question I have for you is, do you think, though, they just they stayed their welcome too long when things recovered, and that's what led to part of the reason?
So I think the problem was they succeeded. That was the problem. They didn't think about the consequences of what if this all works.
Okay, so the economy didn't go to shit. We succeeded.
It was too good. Again, everyone you know was able to pick up and say, I've always wanted to live in Florida. I'm not joking.
Not just that, but the people were running out of asset classes that they started making up NFTs
started inventing.
and coin. Yeah, because real estate, everyone bought all the houses and all the private equity, and the market, everyone's in the market. So we started inventing asset classes.
We ran out of things to trade and speculate on. There was no sports on TV.
No.
Keep in mind.
Yeah.
We had to create new things to gamble on. That's how much money there was. Still is. Here's the fiscal response. This is hysterical. The fiscal response to the great financial crisis was cash for clunkers. Do you remember this?
Yeah. Yeah.
This was like, sell the government your used car or something, and like we'll give you $1,000. I don't even know what was going on. This was, they lit the fireworks factory on fire. Okay? They fired everything at once. It was like a cartoon. It was a cartoon.
Yeah.
The problem wasn't that they overstayed, which they did. It's another problem. The real problem is that it worked. You didn't have anyone that had to be at a job. And that's why wages went nuts. You didn't have anyone that was falling behind on rent. And that's why landlords were able to get away with obscene increases on rent. They have the money. I know they have the money. I just saw this guy baking bread on a Wednesday. You would walk through the malls in 2022 during the reopen, 2 years after the pandemic, and you would see thousands of people walking around with AirPods. And it's like, it's a Wednesday. Why aren't these people at work?
No jobs?
They are at work. They're doing their job from the mall while they buy things. But so it's not so much that they overstayed and the Fed should have raised rates sooner and blah blah blah. The real issue is that it worked. And that's the message that I was trying to get across, is like, it can't be this way. You have to have people that are still desperate. You have to have people that still haven't made it yet, and they're willing to do these jobs and they're willing to go work. And all of us know that feeling. Unless you were born with immense wealth, everyone knows what it's like to, if I don't show up for work this week, I'm not paying my bills next week. We need people that are under that pressure, and we alleviated that pressure for everyone all at once. And it was a really weird thing to do. It was with the best possible intentions. The problem is it actually worked.
It's a heck of an experiment.
You have a mouse in your house, letting a lion in to catch the mouse. Okay, great. You caught the mouse. Now you have a lion in your house. That's what we did. It was Looney Tunes.
When you say social experiment, like, you don't experiment with like the entire world and the entire economy, but that's kind of
They did.
That's what they did.
Yeah.
I don't fault them for a once in a century pandemic doing what you have to do, but
We won't do it again if the next one is within our lifetimes, because the memory of, oh wait, that wasn't good. We gave people unlimited amounts of time. They were out in the streets protesting. They were rioting. They ransacked the Capitol. They were justice shopping. They were breaking into sneaker stores and neither side wants that to happen again, and we won't rerun that experiment. I think the Fed does not want to go there again. I don't think they want to have another inflation bout like we've just had. So if we have another pandemic within the next 15, 20 years, I think the memory will be visceral enough that we're not going to rerun it.
But I also think tied into, and I'm not blaming the Fed, I'm just saying that, okay, after the financial crisis, they do what they have to do. After the pandemic, they do what they have to do. But the reason I use the Y2K example is when you can anticipate something potentially being a shit show, they want to alleviate by providing liquidity and all that stuff. My analogy currently now is obviously the most divisive the country's ever been. And this election is going to be a shit show one way or the other. This isn't a political statement. So I've noticed, because I watch the tape and I read the tape all day, it's just been a relentless bid. And I think interest rates aren't at zero, but there's definitely the Fed on our side. And my theory, I'm curious what your feedback is on this, or your response, is I think they're doing everything they can to prevent whatever happens and whatever happens with the election. I think they want to make sure that the market still runs smoothly.
There's probably some element of that. I
don't know if that sounds too conspiracy theory, and I'm not trying to be. But go ahead, sorry.
There's also talk that the Fed's 50 basis point cut, in light of the data we've received since August, was probably not needed.
Yeah,
could have done 25 or could have waited. And then there's this talk that, well, we're in a budget deficit. Congress has to fund this deficit by selling more debt. If you enable them to sell debt at a lower interest rate, it kind of takes some of the strain off the system. Look at the policies of Kamala Harris and Donald Trump. Kamala Harris is going to blow up the deficit even bigger by another $3 trillion. Trump is going to do it by $7 trillion. Although his argument is there's going to be so much growth, we're going to grow our way out of the debt or whatever. Doesn't matter. Pick a flavor that you like. You like strawberry, you like vanilla, I don't care. The bottom line is neither party is running on the premise of I am going to rein in the budget deficit, right? So there is an argument that the Fed needs to facilitate Congress being able to sell more bonds, and as a result has to lower rates. The problem with that theory is that the average maturity on the Treasury's debt is like 5 years. So if they cut rates now, it's not really going to help them in any material way by the numbers. So what might actually be happening is we're still living on the runoff from all of the stimulus 4 years ago. It's not that people haven't spent the money. It's that there's a multiplier effect. You ever hear the phrase, my spending is your income? Your spending is my income?
Yeah.
Okay. So the multiplier effect, the money doesn't disappear into the ether. It gets used and then reused and then reused, and that's called the velocity of money.
Yeah.
The velocity of money is very high, especially when compared to the post-financial crisis period. In the post-financial crisis period, if people had excess money, they left it in bonds and they weren't turning it over as quickly as we would have liked. That's why the recovery took so long. That's not the case now. Now, I come into your bakery, I spend more than I normally would. You take that money, whatever's your profit, you hire 2 more people.
Yeah.
Those people lease nicer apartments because now they're employed. That velocity of money is really what I think is manifesting itself in higher stock prices. We're a services-driven economy. The profitability of the Fortune 500 companies has never been higher. And that profitability has never been higher because they've been able to pass along higher prices for goods and services in the economy, and people keep paying them. And why can Netflix go to from $11 to $22 in 3 years? Because nobody canceled at 15 or 17 or 19. That's velocity of money. So my idea, my big overarching idea is the Fed shrinking their balance sheet and removing liquidity? A little bit. Was the Fed very tight on interest rates? A little bit. But in the end, corporate balance sheets had tons of money. We have $17.8 trillion in U.S. household cash. Think about this. Not wealth, cash. $17.8 trillion. The Fed has been unable to affect that, and actually, with 5% interest rates, has helped people grow their cash. How many people do you know that are sitting with big cash balances earning 5% over the last 2 years?
Perfectly happy with it.
That's the wealth effect. That's people like, wait a minute, my cash is making cash. I haven't seen that happen in 15 years. Oh my God, I'm rich. So that's, I think, what's feeding into stock prices now and earnings growth and profitability. We have this velocity of money, and the Fed's interest rate hiking cycle hasn't really been able to do anything to stop it. It's extraordinary, but here we are.
Yeah, the Fed raised rates 500 basis points in 12 months roughly for the first time in the history of the markets, and the markets are higher than when they first started.
If you had cash, they made you richer.
Yeah. And I'm not here to this isn't a blame the Fed. I'm not one of those people because I think they have an impossible job. So I'm never one to blame the Fed. I'm just saying that from a simple-minded watching the tape, it's a relentless bid. And I'm not saying it's only because of the Fed. I just know Marty Zweig, don't fight the Fed when they're providing liquidity. I think that's a brilliant line. But you're right. That's why I wanted your opinion, because there's a lot more to it with earnings growth and the AI boom and all this other stuff. So I'm not saying it's only that. I'm just amazed at how every dip is getting bought. And in my head, I'm like, the liquidity's insane.
Here's a stock to watch. Watch Marriott. MAR. I think it's making a 52-week high right now. It had a swoon this summer when some of the data started to look recessionary. But we found out what actually happened was they had weird weather in Texas, and then we had the hurricane stuff on the Gulf Coast, and that kind of carried through to later in the fall. But once we got past all of those blips, all of the labor market data just resumed, and everything got back to a place where we said, "Oh, forget it, no recession." So bond yields started to rise again.
Yeah,
stock prices. If you just keep your eye on Marriott, Marriott is the poster child of this moment. They have high-end resorts for rich people. They have bottom of the barrel, like lowest possible price for a night, and everything in between. They have timeshares. They're in vacation places. They're in business travel. Like for me, I watch stocks like that. When Marriott resumed after that summer swoon, I just said, the market's smart. Why is this thing ripping again? Oh yeah, because it turns out we had some funky weather things happen, and we're not starting to see recessionary data at all. That stock does not do what it's doing in a recession, and I know because I'm doing this 25 years. So, I feel like the market is smarter than the economists, certainly smarter than the politicians. A lot of my insights are market-based insights. I look at what people are actually buying and selling more so than I listen to whatever shit they're saying. And I think that's a really helpful thing for the listeners, like a heuristic that will probably make them money forever. Watch what I do, not what I say.
Yeah, I've been saying for the past year when everyone's saying recession, I'm like, have you left your house?
Yeah.
Have you been to an airport?
Yeah, where?
Have you gone to even fast
casual? You gone out
casual?
to dinner?
You go to a Cheesecake Factory, 45-minute wait on a Tuesday. I'm like, what's going on here?
Yeah.
I'm like, this isn't like all high-end stuff, just medium level, fast casual. You go to a airport, packed. All the TSA numbers are insane. Hotels.
Go try to buy a Rolex. Like call up a jeweler, tell them a specific model you want, ask them how long. That's not recessionary.
No, and to your point, Royal Caribbean's at an all-time high.
That's right.
I mean, not just Marriott, Booking Holdings, the old Priceline. I'm like,
here's
there wouldn't
funny.
be a recession if these stocks were at all-time highs.
You listen to the guy from Home Depot, and he says, I forget the new CEO's name, and they ask him, well, surely with rates at 5.5%, that's got to be hurting existing home sales. He's like, yeah. Well, aren't existing home sales good for Home Depot? He's like, doesn't really matter. If you're stuck in your house, you're going to repaint it. If you're moving to a new house, you're going to paint over someone's ugly paint color. Right? Like there's an element to this. So Joe, this is important actually. We used to have a more cyclical economy because it was manufacturing driven. So in a manufacturing economy, what ends up happening is time goes by and inventories build up, and then demand slips on the part of either consumers or businesses or both.
Right.
And then all of a sudden, you have a company that's sitting with all this inventory. They have an earnings call. They come out and they say, "We screwed up. The demand didn't materialize. We have too much inventory. We're going to take a charge off to our earnings for all this excess inventory, and revenue is light." And then what's the next thing that happens? That company lays off 20% of the staff. Because why wouldn't they? We don't need to make more of this shit. We have a warehouse filled with dishwashers. We're not going to make more dishwashers for 6 months. We're going to cut 20% of our staff. That's a manufacturing-based economy. That's the United States in the post-war period up until the internet age. It's different now. I was talking to Warren Pies on our show. He was talking about the only thing he watches in employment data is construction jobs. Construction jobs are only 5% of all jobs, but they get the hardest hit in recession. Construction industry loses 30% of its workers in a recession. So he's like, if you're going to watch any jobs number, watch construction jobs. There's no sign whatsoever that we're in any sort of recession, pre-recession. So when you know what to look for and you understand where the rubber meets the road, you can save yourself a lot of time and not listen to every opinion out there.
But going back to what you said, you think sometimes those opinions are because people want a recession or they're bitter about something and their personal views are affecting their analysis?
Let's say you're an economist who works for a Canadian investment bank that underwrites gold mining deals. Okay? You build a reputation as like this curmudgeonly, he calls it like it is, you're right? And you say double dip recession in 2012. It doesn't happen. Then you say the next year, 2013, the market takes out the old highs from 2007. And you say, market's frothy. It doesn't matter. We rally another 7 years. Then you say the recovery, the trade war is going to destroy the country, Trump's trade war. That doesn't happen. Then you say the Fed made a policy error. The Fed reverses. Doesn't affect the market. Then we have COVID, and you say, we may never recover from this. This is a once-in-a-generation financial crisis. And then 6 months after they close all the schools, the S&P makes a new record high. Then you say, the stimulus isn't going to work. And then you see, obviously, it works. Then you say, Biden is a bum, and he's going to screw, or you say, the Fed is too late on raising rates, and it's going to be the 70s. As each one of these negative things fails to materialize, you, like playing Zelda, your hearts like disappear. They're blinking. You have half a heart, lose a heart. You start from 10 hearts, you're down to one last heart. You need the market to crash to justify 15 years of telling people about worst case scenarios, none of which play out. You literally need the market to crash, not just to justify your stupid fucking newsletter, to justify your life. What did you just spend the period from 2008 through now doing, if not trying to talk people out of investing and literally derailing the portfolios of millions of people who listen to you? You don't just want the market to crash. You don't just want the next bear, secular bear market. You need it. You need it with every blood vessel in your body, every fiber of your being.
This is a few good.
This needs to happen now.
Speech.
I know
you
these.
need the market to crash.
Joe,
you want the market to crash.
I know these guys.
Yeah.
I see them in the green room. I understand by their mannerisms how much pressure they're under. I know these. They've gotten divorces. I know. Now, this is not me sitting in judgment of someone else, because I'm wrong all the time too. But there is a peculiar species of person, tends to be very active on social media, who wants to infect everyone around them with negativity, worst case scenarios, reasons to not invest, reasons to think the future will be worse than the past. These are the people that build big audiences. And the reason why is because they sound different from everyone else, and it's compelling. It's always very intellectually satisfying to listen to these negative bear case kind of scenarios. They make sense. And when they don't play out, you see what these people do. They move right on to the next one. Like it never even happened.
Yeah.
No humility. And so it's very dangerous to be out there and not be armed with the knowledge of the way things really work. You could become susceptible to what these people are saying at any time.
I mean, fear is a powerful force, and fear sells, unfortunately.
Pessimism sells, skepticism sells.
If I write a blog post Dow 100,000, and if I write a blog post Dow 5,000, the 5,000 will get infinite, like 20 times more clicks.
The 100 will get mocked relentlessly.
Yeah.
Even though if you put a time frame on that, if you said Dow 100,000 by 2040, it's entirely reasonable given the market's long-term historic return.
But it's the fear. It's one of the lines I learned from you is no one watches the Weather Channel when it's 75 and sunny out. They only watch it when a hurricane, tornado, or blizzard's coming. So no one wants to read blogs, financial television when everything's at the highs. The best ratings are when there's fear.
I think there's another element to this. I wonder if you think the same. There's this thing. It's specific to men. Men want to save the day. Like, men want to be the one that spotted the danger and saved everyone. I think that there is an element to human nature, specific to men, where they want to be the person that called the top and everyone that listens to them got out. Or they saved you from the financial crisis. Or they saved you from Bitcoin blowing up. Or they warned you in advance that inflation was going to get really bad, and if you just listened to them, you would have been fine. I really think that this is like part of the human condition, that a lot of us feel some pinge of that. Like if I get everybody out, like I will be carried off the field on their shoulders. And so you do tend to also see a lot of people just constantly making warnings, as if the rest of us don't know. So, there could be a recession. Oh, there could. Really?
But a lot of times they don't know what they're talking about or doing. It's no different than the person on the side of the road.
But
it's like, I don't know anything
about
about cars, but I'm going to go help them to save the day.
But tell me if you think I'm right about this. I think it's more satisfying if you go against the crowd and make the call that saves millions of people a lot of money. That's more satisfying just doing that once than for 10 years telling people keep investing.
Is
the
it
market
more
keeps going up.
satisfying for your own personal ego?
100%. I think it is.
That's all it is.
I think it is. I think the people who have done that in the great financial crisis have been trading on that ever since. Like they've been living on the fumes of that. Like I called the crisis.
Yeah.
They're still out there. Most of them have not been able to flip positive. Because here's the other thing. When you make a huge call like that and you were right, and not just you were right, everybody was wrong. Think about how good that makes you feel. Like you feel like a celebrity.
You know who's proof of that? Elaine Garzarelli.
Sure.
Called the crash in 87. And
never heard from her again.
Still comes out once in a while because of something 40 years ago.
So here's why.
Go ahead, sorry.
So here's why. You want that feeling back. So you don't just want a recession because you're calling for a recession. You remember what it felt like to be Nouriel Roubini in 2010. Like this man could not walk 5 feet without signing autographs. He was the guy.
Yeah.
And if you're Roubini, you want that feeling again. You want to be invited to all the parties. You want to have paparazzi following you. You want that feeling back. You don't even know it, but you do. And so that you can't tell me, because I'm human too, you can't tell me that doesn't color your commentary for the next 10 years. Of course it does. Of course you're going to be a pessimist because you want the calamity again so that you could be the person that saved everyone. I know that it's no different, and you know a lot more rock stars than I do, but you think about somebody that had a huge hit in their career. For the rest of their career, they want to write that song again. It's a different song, but they want that feeling again of being number one on the charts, being invited to play in all the hot clubs and arenas, having like little boys and girls come up to you for an autograph. Of course you want that. Who wouldn't want that feeling back? So now I say all this to say, be really careful about the person who just made the call of a lifetime. Understand that they are now going to spend the next 10 years trying to get that feeling back. So their pronouncements are going to become more extreme, not less. And they're probably going to play the old hits.
Yeah.
How many people called the crash? I know one person, Barry Ritholtz, and then called the bottom in the stock market. He's like the guy. He's the only guy I could think of.
Yeah.
2 years after, I knew him, and he would start getting a little bit negative, a little bit. I'd be like, Barry, I know you want to call the top again. He'd be like, no, not me. I'm like, everyone would. Of course you do. So there is that tendency, and it's incredible. Look at what's happened to the professional careers of the people who made that call. Phil Falcone, he blew up a $40 billion hedge fund. It's zero. Okay? John Paulson could never recapture
I was about
it.
to say Paulson should have retired.
And this is not this is not me dissing people.
No,
they made this incredible call. There are probably 15 of them, let's say. What's the guy? Mark Faber, the Gloom, Doom, and Boom report.
Yeah.
It's a group. Rubini. None of them have been able to repeat that. This is the only thing that they really want. They want that feeling back because it probably felt like John Bon Jovi feels stepping off the stage at the Meadowlands. Like that's probably what it feels like. So if you're a spectator of this, if you're an investor in the markets, you need to be on guard for the guy or gal who just Meredith Whitney. Oh my God.
Another one.
You need to be on guard for the person that just made the mega call. And it's in both directions. Because we could talk about Cathie Wood predicting the innovation economy in 2020 and then tripling 6 different ETFs in 2021. Don't you think she wants that moment back more than anything in the world? What she wouldn't give for another ride on that roller coaster? Like, it's really, really tough for these people to follow that up. For anyone, quite frankly.
But that's another example of she has that killer year, 150% on an ETF.
Crushed it.
And same thing with Ken Hebner in 2007, has an 80% year.
Bruce Berkowitz, the Fair Home Fund.
Yeah, so I'm not picking on Cathie Wood, but these people have amazing years, and that's why the disclaimer, past performance is not indicative, because human nature, after an 80, 100, 150% year, 300, whatever the percentage is, everyone plows in. So Ken Hebner had $2 billion, he went to $10 billion. Then at a 65% drawdown. Cathie Wood went whatever, you probably know that, you know the numbers, but she had this incredible year. Everyone plows in and then has the 70% drawdown.
And Joe, these people have higher lifetime losses than gains for investors.
Yes, longer term, they've lost people money.
They've like these people that have become so synonymous with a big bull market. When you actually look at like a decomposition of not time-based returns, dollar-based returns. So, like, what was the actual experience of the money that came in after? So many of them end, and it's not their fault. What are you going to do about it? So many. You have a really great year or 3-year period, people are going to give you a lot of money. Like, that's what we're here for.
I remember I was telling you about Cathie Wood.
What are you going to do about it?
She did it in 3 ways. She was concentrated, picked the right stocks, and wrote out her winners. But at some point, when you make an incredible call on Tesla going from split adjusted 10 to 400, whatever she said, and I remember telling you, I said, at some point you got to cash out. But you said, what's she going to do? Go to cash? Like,
no.
She's running an innovation fund.
No, it's worse than that. She's not Ken. Ken Hebner can say, I'm closing the fund to new money. You can't do that with an ETF. It's freely traded.
Yeah.
She took in $53 billion in a year. You understand?
Yeah.
In South Korea, they had a nickname for her. They call her Money Tree.
Her picture was on T-shirts.
Yeah.
She was a celebrity.
It's not her fault.
Right.
She crushed it. She was amazing. Now, her critics would say she shouldn't be going out on TV and talking about $1 trillion price targets on Tesla. I think it got to $1 trillion, though.
Oh, when their call she made was right.
Correct.
But I was saying, this is the difference between an individual and maybe an institution or a money manager, is that individuals don't have the mandates that You have because I remember the point you made that was so great is she can't just go to cash or start buying like utilities.
No.
Because that's not the innovation fund.
That's right.
But an individual can.
That's right. And this is we had Jason Zweig on our podcast last week, and he talked about the enduring advantage of the individual investor. We didn't get into this topic. This is one of those advantages. So Jason was saying you have nobody to report your performance to.
Yeah.
Your husband or your wife might care. Nobody else cares. So act that way. Stop acting like the quarter is over. What?
People don't understand. Go ahead. Sorry. Go ahead.
So to that point, if you are running an innovation, a suite of ETFs that are premised on the innovation economy, even if you think that there are valuation issues in the market, you're still buying those stocks because that's your mandate. That's your job.
Yeah.
So you're exactly right. If you're a regular person and you say, all right, that was fun. Now these stocks are all falling knives. I'm going to cut my losses from the top. I still made a lot of money. And now I'm going to look at oil and gas because that's working. Or I'm going to do something.
Yeah, something else.
Right. So professional doesn't always have that choice. Most professionals don't run, quote unquote, go anywhere funds.
Right.
Like most of them have a job to do.
Yeah.
And the people listening to this who are not working on Wall Street, congratulations. You don't have to worry
You don't
about
have that mandate.
That's
so
right.
there's some mutual funds that have to be 90% stock, 5% bonds, 5% cash, some of those Fidelity funds, whatever, where an individual doesn't have that mandate. The other thing is you don't have anyone to report to. And, another huge factor is that you don't have, there was something else I was going to say with like position sizes. There's just so many variables that an individual has that they don't realize. Oh, that was what I was going to say. A friend of mine works at a huge mutual fund. They have their meetings every Monday morning. If they like a stock, they might not buy it for months because they'll pitch the stock to the managers. Then they go out and meet with the company and do this. The stock might have already doubled by the time they're even, where an individual is like, hey, I researched this company over the weekend. I can buy it on Monday.
Yeah.
Where they're like, we have to wait at least a couple months before we do our due diligence.
Yeah. And now I'm going to add one more layer to this. And I think this worked against Kathy. And I like Kathy a lot.
Yeah.
And so I've thought a lot about this. And I wrote about her in the book. And I think I did her story justice. She really had an incredible story. She came out of nowhere. I knew her prior, but I think this worked against her. If you run an actively managed ETF, you have to report your trades in real time. No mutual fund manager has ever had to do that. Mutual fund managers have to file a 13F within 45 days of the close of the quarter.
Yeah.
So not only do they not have to report in real time, they could be long out of a position by the time they're reporting that they even owned it.
Potentially during those 90 days.
Right. Retroactive.
45 days later.
Retroactively reporting
She was
something.
posting them after the close every day.
No choice.
She had to.
That's the transparency of an ETF. So I think the ETF wrapper on balance was good for her because it enabled her to have very high visibility of how successful she was. Nobody looks at ticker symbols of a mutual fund. They're five letters and they don't move during the day. Her thing is moving on the app or on Robinhood all day.
Yeah.
So she had very high visibility into how well she was doing because of the ETF. So that worked in her favor. The second thing is the fees were low. Most active managers, 1% or more. So she had that in her favor. The third thing is that the money could just pour in all day long. You didn't have to wait till the fund settled at 4 o'clock and then they reprice an NAV and then the money goes in and it's not traded the next day. So for those three reasons, the ETF worked for her. The reason it didn't work for her is that she was being dissected in the media every time she bought or sold anything. So she would sell a little Tesla and then my network, CNBC, they would spend 3 different TV segments that day. Does Kathy Wood hate Tesla? Is she going to sell the rest of it? Is she going to short it? And it's like, she's got creation and redemption. There's money coming in and out of the fund in real time. She has to buy and sell. Not everything that she does is like a prediction or a market call. But, people don't understand that. So I think it was the first time we ever saw a superstar active manager in real time go from obscurity to 50 billion and have to report their trades as they were doing them. It was really an an incredible moment. We've also never had somebody with 6 active ETFs. Every single one of them doubles in the same year.
Yeah.
So it really goes a long way, Joe, to explaining that phenomenon and the effect it has on market psychology and investor psychology. So I really wanted that to be part of the book because I think it's so unique and it's such a great laboratory to observe the effect on people when you view it through that prism.
Yeah, no, I agree. You interview a lot of people on CNBC. Any 2 or 3 that come to mind when you see them on the schedule or that they're going to be on that either I can't wait to talk to this person, I can't wait to hear from this person, I want this person's views. Anyone that sticks out that like really?
Yeah, that's a great question. So because of where I am now in my life and in my career, I'm much more interested in listening to the builders and the CEOs than I am the traders.
Okay.
It's not that I don't have plenty to learn from people that are coming on to talk about trading. I don't personally get excited about that the way that I do when Ken Langone comes on. And you're just like, holy shit, look at this guy. Like, look what this guy has done with his life.
Incredibly sharp.
Look what he's built.
Yeah.
I'm sure he has a trading portfolio where he buys and sells things, just because why not? But like, who cares? I want to hear about the business he's built. So I've become much more focused on the stories of big investors who have been like long-term in like the biggest winners, or people like Jensen Huang, who built NVIDIA. Not everyone realizes he's the founder and he's still there running the company. And it's been like 5 different companies in the last 20 years. Like I get really excited about hearing from people like that more so than I do hearing from people who are like in the trenches with us, like trying to figure out what stock to own for the next 90 days. It's not that I don't learn from that. It's that I'm thinking about my own firm that I'm building, and I'm trying to learn from people who have done it.
Yeah, no, that's a great response because it's more relatable to you as far as someone building something is.
Yeah, so I like Dara. Every time Uber reports, and I'm a shareholder, it's my biggest position. Other than NVIDIA, Dara does an hour with David Faber every time they report. That's, for me, must watch. I listen to Jamie Dimon, Danny Meyer, the founder of Shake Shack and Gramercy Park Tavern, some of the best restaurants ever. Literally wrote the book on hospitality called Setting the Table. I want to hear from people like that when they come on, and it's rare. But like, from my perspective now as somebody who's an entrepreneur trying to build a company, I feel like I get a lot more out of those conversations than the other conversations.
Yeah, no, I like that. I have a bunch of stuff here we didn't even get to yet.
Go ahead. We could lightning round. We
have to. I'm actually, since I'm starting this podcast, and I appreciate you being on. You've been very successful with your podcast as well. That you run multiple. For people who are interested in doing this, or even advice from me, I was curious, like what we were talking a little bit before on air about what makes a podcast successful, advice, anything like that about, I know consistency. Your colleague, Michael Batnick, says you better be consistent, and God bless him. He's been 380 something episodes every week, records, drops it at the same time.
Animal Spirits, yeah.
Animal Spirit. I mean, like 6 years of consistency.
So I think I told you this before, but I'll tell you this on the air. I think it's not about you. It's about the audience, each individual member of the audience. And that's the thing that you have to remember with podcasts. With TV shows, people flip through the channels. Nobody finds a podcast that way. And so people are they subscribe to it. It gets downloaded into their phone. That's only half the battle. You have to become part of their ritual. Listening to podcasts is a ritual. I listen to this when I run. This comes out every Friday. I go out for a run on Fridays. I listen to Joe Fahmy. I listen to Josh when I'm commuting to work. Josh comes out every Tuesday night on my way home from work. Like whatever it is. So you have to pick a cadence that's realistic. For most people, it's once a week. I think anything less than that, you better be doing something really special, like the guys at Acquired. They're not really on a schedule, but when they drop something, it's 6 hours, and it's like an epic deep dive into LVMH or Costco or Nvidia or Meta recently. They just did one on Meta. That's going to be my flight back. I'm going to listen to that. But for most people, it's a week. Okay, so when in the week are you going to drop it? Well, that'll be dictated by like when is it relevant, and also when can you record it, like the logistics of you. But then always remember this one thing: you have to become part of people's ritual, where they always listen to you on a certain day at a certain time while they're doing blank, because everyone is multitasking. Nobody is sitting down like a psychopath, staring at a wall and listening to a podcast. Like this is obvious shit,
going
but
to work,
it should be
walking, doing the dishes, running, whatever. Yeah.
So I have my shows that I listen to, and they're a ritual for me, and I know when they come out, and they always hit at the same time, and I'm always doing that thing at that time, and that is how you become part of someone's life. So I think that's a really big thing. The second thing is you can't just rely on stunt casting, because you're going to have amazing guests, and then you're going to go weeks in between with good guests, but not celebrities. So if you're reliant, like every guest I get is a celebrity, you're going to run out of famous friends after 5 weeks.
Yeah.
And then it's like, Mike's here. Mike walks my dogs. The people have to be there for you. You should also assume, you, the host, you should also assume every famous person that does your show is doing 5 other people's shows. So it really has to be a connection between Joe Fahmy and the audience. So that's my second piece of advice. So it's ritual. It's build a relationship with your audience. Don't rely on celebrities. And then the third thing I would say is leak a sex tape.
All right.
It doesn't really matter if it's grainy or if it's black and white or it's a security camera kind of thing. Just give people that like extra idea of like, oh wait, this guy's got some stuff going on. Right. You don't have to do the third one. I'm just saying it's like one extra thing that you could do.
All right.
Doesn't seem like you're going to listen to that piece of advice. All right, so stick to the first
the
two.
Sex tape
then.
has to be with someone though, right?
Not necessarily.
Just making sure.
Do the first. Listen to me. Be consistent. Become part of people's ritual. Number one, and then number two, make it about your connection with the audience. Not look how famous my guests are. Those are the number 1 and 2 things that when I think about what I listen to, that's the thing that those people get right.
No, because the reason I ask, because when I've been lucky and honored enough to do your Compound and Friends a couple times, and it drops on Fridays, I believe, I get emails from people like I went to high school with that I've never even heard from.
Yeah.
And they're like, so awesome that you're on. I can't wait every Friday till this drops. It's my favorite podcast. So clearly you guys are doing something right. That's why I'm picking your brain, because it's a phenomenon where it's awesome that enough people like they can't wait for that certain time to listen. And it doesn't matter if the guests are famous or not. You're right. It's just
we've been fortunate in that we were very consistent from the beginning before we realized how important that was. The logo of the Compound and Friends says the word Fridays in the logo. We spell it out with New York City subway letters. Like,
oh yeah, I've noticed
that. Podcast drops every Friday, come hell or high water, or if I'm away for a week and we tell the audience in advance we're not coming next week. But like we were early to recognize that, not just like, oh, we interviewed somebody and the market's moving, we better put out their thing really quickly while it's still relevant. That's a tougher game to play, trying to be live TV and trying to, like, in the moment, you have people talking about what happened in the market that morning. You can't be consistent. You can't hold that till Thursday if you said it on Monday. It's worthless.
Yeah.
It's confetti after a parade, right? It's like, oh, these guys had all these opinions about the market 3 days ago. So in our thing, if you're going to do very market-focused content, it's got to come out immediately. I don't recommend it. I think what you're doing and what we're doing and what some of my favorite shows in finance, like Invest Like the Best, Patrick O'Shaughnessy, Ted Seides, talking to people that take their profession seriously, having a real conversation, it's worth waiting and putting it out consistently so the audience can build their routine around it. No,
that's great advice and it's great words there. I know. I feel like we could talk on for another.
Well, we're gonna go on to Peter Luger after this. I have plenty of material left for you.
And we got some rock stars coming with us too.
Okay,
so
good.
maybe some magic too. So you never know.
I got plenty of material. Don't worry.
I appreciate your humility. I appreciate our friendship. Thank you for doing this. The people I've been gravitating as I'm getting older are the people who are, and I'm not just saying this because you're here, people who are amazing at what they do, but are still super humble about it. Because arrogance is I hate. I'm sure a lot of people do. So
that's not my brand. I'm not known for arrogance.
No, and I appreciate you. I mean this sincerely because I know friends who are musicians that are super humble and will say, "Hey, that person's a great musician," or a chef who's like, "You got to go to my friend's restaurant." I'm like, "But you were just on Iron Chef. You're talking about someone how amazing someone else is." And
I like people like that too.
And you've been super humble to say whenever you've introduced me to someone like this guy's an amazing blogger, this guy's an amazing money manager, this guy's an amazing stock picker, great macro guy, and I'm like, well, so are you, but it takes a special amount of humility to not only recognize that in someone else but also promote someone else, and I appreciate you for that.
My man, I have an idea. Since it's the first one you're dropping, we can start a tradition. What if you end each show with like a pound across the table? Can we do it?
All right.
Thank you, Joe.
Thanks for being here.
All right.
Appreciate it.